Hey, welcome back. My name is Michael Anthony, and on this channel, we empower badass achievers like you to crush their financial goals and experience true wealth and freedom. Well, as Buffett famously said, bad news is an investor's best friend. It lets you buy a slice of America's future at a marked down price. It's that kind of mindset that sets the great investors apart from the rest. Let me explain. Back in '08, the global financial scene was hit with a massive curveball. It was like nothing we'd seen since the Great Depression in the 30s. This event, known as the global financial crisis, brought with it a wave of economic hardship that rippled across the globe. You might be too young to remember, but all you could see were high unemployment rates, plummeting GDP, and businesses going under left and right. It was bad news bears, man. It was a tough time for everyone. But in the middle of that chaos, there was one figure who stood out, Warren Buffett, the Oracle of Omaha, and his company, Berkshire Hathaway. While the world was gripped with fear, uncertainty, and just all hell was breaking loose, Buffett saw an opportunity where others saw disaster. In a move that left many scratching their heads, Berkshire Hathaway invested a cool $5 billion with a B in preferred stock in Goldman Sachs. Now, you might be wondering, why on earth would anyone make such a bold move in the midst of a crisis? And for those of you who are too young to remember all this, banks were failing left and right. So for Warren Buffett to invest billions in banks while they are falling left and right and the global economic system was teetering on collapse was visionary and savvy, to say the least. That is the interesting part. So fast forward 3 years later, and Berkshire Hathaway's gamble paid off big time. Goldman Sachs redeemed the shares, netting Buffett's company $3.7 billion. And even now, a decade down the line, Berkshire Hathaway still holds $3.13 billion of Goldman Sachs. Talk about savvy investment. So what's the takeaway from all this? When the chips are down and the market's in a free fall, what's the best course of action? Should you panic? Pull out all your investments? Or should you take note of what Buffett's playbook looks like and seize the opportunity? Stick around, because I'm about to share with you 6 golden rules for navigating market crashes like a pro. So trust me, by the end of this, you'll be itching to dive headfirst into the world of investing.
Here comes the money. Here we go.
Even when everyone else is running for the hills. Rule number 1, keep calm and plan ahead. When the market takes a nosedive, I've got 2 strategies up my sleeve. One for the heat of the moment and another for learning and growing afterwards, preparing for the next crash. Because yes, there will be a next crash. So first off, when the panic sets in, I turn to something that might seem counterintuitive: meditation. Yup. You heard that right. Amidst the chaos of plummeting stocks and media frenzy, I practice breath work and meditation to clear my mind of all the fear and anxiety swimming around, okay? And it's not just about finding inner peace. It's a tactical move to push out the noise and to gain mental clarity. By focusing on my breath, I can distance myself from the frenzy and make decisions with a calm, cool, collected mind. But my strategy doesn't end there. See, once the storm subsides and the market stabilizes, I go on a hunt for success stories. I seek out individuals who not only weathered the storm, but they came out on top. I study their mindset, their actions, their every move. It's not about copying them. It's about understanding the principles that guided them through all of that chaos. It's a post-crisis analysis that not only prepares me for the future, but also enriches my investment philosophy with battle-tested tactics. Remember, it's not just about having a plan. It's about being in the right frame of mind to execute it. So next time the market crashes, take a breath, stay calm, and keep your eyes peeled for the lessons hidden within the chaos. Number 2, invest in what you know, yo. Have you ever heard of Warren Buffett's circle of competence? It's like the North Star for seasoned investors, a guiding light that keeps them on track. Buffett himself has steered clear of high-tech stocks for years because he couldn't confidently predict which ones would come out on top in the long run. I learned this lesson the hard way. Back in '08, enticed by the allure of big returns, dollar bills, y'all. I strayed from my circle of competence. I took a leap into the unknown and invested in Circuit City, a company already on shaky ground, and I'm being generous, without a solid grasp of the company's financial health or the electronic retail market. My decision was more of a gamble than a calculated move. And boy, did I pay the price for my ignorance. Circuit City went belly up, leaving me with nothing except regrets and empty pockets, and an awesome story to share with you so you don't do the same thing. The moral of the story? Stick with what you know. Okay? Invest in familiar territory. It isn't just a safety net, it's a strategic advantage, especially when markets go haywire. This rule drives home the importance of staying within your comfort zone, leveraging your expertise to navigate uncertain times, and making decisions that serve your long-term financial goals. Trust me, it's a lesson you won't want to learn the hard way. You do not want to learn this the hard way. Rule number 3. Understand market dynamics. Understanding the ins and outs of a market crash is not a luxury. It's a necessity for making smart investment moves. It means going beyond surface level panic and diving deep into the root causes of the downturn, analyzing how they might shape the market's recovery. So now let me share a little secret with you. My go-to weapon for staying on top of financial markets for the past 16 years has been none other than the Wall Street Journal. Yep, you heard it right. Daily doses of the Wall Street Journal have kept me sharp and informed. I'm not talking about just page 1. I'm talking about diving into page 16 of the 4th section. Okay? This has kept me sharp and informed, helping me keep my finger on the pulse of the financial world. And here's something else I've learned along the way. Always keep your eye on the big picture. Macro trends can be game changers, especially during market crashes. So take the recent focus on green energy, for example. Governments all across the globe are pumping stimulus money into eco-friendly initiatives, hinting at massive opportunities in sectors like renewable energy. It's all part of a broader shift towards sustainability that savvy investors can't afford to ignore. And also, quick note, just because clean energy is all the rage doesn't mean you go and invest in it, okay? Because there are a million stocks that will go belly up if you don't know your shit. You gotta know what you're investing in. So don't just invest blindly in something because you believe it's gonna go up or you see the macro trend. You have to invest. You have to study and know what it is, who it is you're investing in. But here's the thing. No two market crashes are alike. A deep dive into the '08 and 2020 crashes reveal very big differences in their cause and effect. The housing market meltdown of '08 stands in sharp contrast to the pandemic-induced chaos of 2020. Understanding these nuances, it's not just academia head knowledge. It's the key to crafting a winning investment strategy that stands the test of time. And let's not forget about government intervention. The level of support or lack thereof for different industries during crises can make or break investment opportunities. Look at the contrast between the bailouts handed to financial institutions, i.e. banks, in 2008 and the struggles faced by sectors like cruise ships during 2020. It's a reminder political decisions do have a profound impact on market dynamics. And smart investors need to factor into their calculations that very thing. So the next time the market takes a tumble, don't panic. Take a deep breath, grab a copy of the Wall Street Journal. Yeah, physical copy. I get them delivered every day. It's worth the investment. No, they are not a sponsor, but holler at your boy Wall Street Journal and start dissecting the situation like a pro. Because when it comes to navigating market crashes, knowledge is power. Rule 4, timing and opportunity. The wild swings in crypto markets, especially during downturns, can really put investors to the test. Hashtag diamond hands. Okay, my own experience during the recent crypto crash serves as a prime example of how to navigate turbulent waters. In the middle of all the doomsday predictions about Bitcoin going to zero, I stuck to my guns. I stayed true to my established strategy. Instead of playing the guessing game to time the market perfectly, I took a very pragmatic approach. I implemented a dual strategy of dollar cost averaging, DCAing, to steadily build my position, and then I set aside reserves to invest at predetermined price points. And you know what? It worked like a charm, baby. Some of those price points, they hit. They allowed me to swoop in and make awesome purchases. And even when the market didn't quite play out the way I wanted or expected, it didn't throw me off. It just reinforced the importance of having a flexible strategy that can roll with all the punches and adapt to changing market conditions without relying on speculative hype and guesswork, okay? This approach didn't just lead to financial success. It brought a sense of calm, of clarity, of peace. By avoiding the frantic rush to time the market, I was able to stay composed, confident in my strategy. And at the end, that discipline and foresight paid off big time. Not in theory, in real, tangible results that strengthened my portfolio. So the next time the crypto market starts to get rocky, and it will, remember, stick to your strategy, stay flexible, and keep calm. It might just be the key to weathering the storm and coming out on top. Rule number 5. Staged investment strategy. The 2020 market crash was a roller coaster for investors, presenting challenges and opportunities. And in the face of uncertainty, I opted for a stepped allocation approach, a decision that showcased both strategy, foresight, and emotional resilience. Rather than waiting for the stars to align and investing a big sum of money all at once, I divided my capital into stages. This method allowed me to seize multiple opportunities and to invest at different points throughout the market's ups and downs, while also acknowledging the futility of trying to predict market bottoms and pinpoint all that accuracy. The beauty of this approach went beyond financial gains. It also provided a sense of psychological comfort. I could just rest my mind. By spreading out my investments, I sidestepped the what-if scenarios that plague us as investors. Timing didn't have to be perfect at each stage. What mattered was making calculated decisions that contributed to an overarching strategy, minimizing regrets, we've all had them as investors, and reducing second guessing along the way. Here's a nugget of wisdom. Don't make your investment all in one lump sum, unless you're totally fine with the market dipping further and the potential of missing out on buying opportunities. When it comes to allocating funds during a crash, I've found 3 strategies that are particularly effective for me. The quarter, half, quarter approach. So divide your investment into a quarter, half, and a quarter, and then make those investments gradually as the market evolves. For very shaky and uncertain markets, I apply the 10th method, where I invest 1/10 of my capital at regular intervals over a predetermined time frame, 10 hours, over every 10 days, 10 weeks, whatever it is, depending on the market situation. The third strategy, literally 1/3, and it's the third strategy. Split your investment into thirds and deploy 1/3 immediately. Put that puppy in the market so that you get in the game. Then strategically, as market conditions shift, you can deploy the additional amounts. Now, if you want me to make a dedicated video and explain these in more detail, let me know down in the comments. For me, it's all about meticulous planning. I know exactly what I'll buy at what price points and what my next move will be once prices rebound. By sticking to this rule and strategy, I've learned that successful investing during a market crash, it's not about making a single perfect decision. It's about a series of well-informed strategic actions. With the stepped allocation approach, I've managed to reduce most of the risk of mistiming the market while capitalizing on its volatility in a structured manner. Trust me, it is a game changer. Rule number 6, diversification and profit management. Profit, y'all. Defining what constitutes a crash is a highly personal decision, one that hinges on your individual risk tolerance and investment goals. While some may jump at the chance to buy during a 5% dip, others might wait patiently for a substantial 20 to 40% downturn, or in crypto, an 80% downturn before making a move. The key is knowing where you stand and what you're comfortable with. And to pinpoint your sweet spot, it's crucial to envision 2 scenarios happening at the same time. Scenario 1, where the asset drops lower than your desired threshold, and the other, where it rebounds sooner than you expected and you didn't end up buying.
Imagination.
So imagine buying something at a certain price only to see it go down another 40%. How do you feel? Okay. Now on the flip side, imagine you're waiting for a 30% drop, but it only dips 20% and you never buy. Would you regret not buying at that 20%? For me, I've put in the work, y'all. It is work to identify my ideal buying points and how I'll navigate market fluctuations. Currently, I'm focused on one asset, Bitcoin. Once it rebounds, I plan to take half of the profits and reinvest them, either in real estate or one of my companies, depending on the circumstances at the time. The principle of diversification and intentional profit management guides my approach. By spreading my investment across different assets and wisely reinvesting profits, I am building a resilient and strong portfolio that can weather almost any storm. It's all about staying flexible, strategic, and proactive in pursuit of long-term financial success. Remember that the key to a successful investment strategy during market crashes lies in preparation, education, and adaptability. Remember to smash that like button and watch this video next, okay, for more amazing content. So until I see you again, you keep living your life to the fullest. Peace.